Good afternoon, everyone. My name is Zishan, and today we are here to talk about RWAs. The thing which has been, buzzword for years, but now the transition is such that institutions are quietly, building teams for. They are heavily integrating it. We have been, joined by an amazing panel who is just not tweeting about it, but are actually shipping credit, infrastructure, custody, liquidity, all about it. So I would request the panel to if we can have a quick round of introductions from the houses mouth themselves, and we can kick off the introductions then. So I'd like to start with Sebastien. Can you please?
So I'm supposed to introduce
Yeah, I
myself?
would request if we all give our introductions quickly.
Yeah, so I think who in this room has a ledger? This is very low. This is very, very low. So we should have a booth outside so we can sell them. You should all have a ledger, I think. So Ledger is a 11-year-old company. We're based out of Paris, France. What we do is we do security for the ecosystem. We've created a hardware wallet, which basically allows you to do everything that you would want with your crypto, but especially keep it safe. 20% of the world's crypto is protected by Ledger today. So it's something that we take very seriously because that's a lot of money. And then, we started on the consumer side, on the retail side, because obviously, crypto started as a retail product. And we've moved towards the enterprise side, and we have an enterprise offering with Ledger Enterprise, which is the part of the business that I run. And our customers are custodians, exchanges, asset managers, etc. And then a couple of months ago, we announced during Ledger Open, which is our developers conference that we do every year, the launch of Ledger Multisig, which we built on top of Safe, which allows for any DAO, family office, etc. If you have like 2 or 3 people in a company, and you can't have one person holding the keys, to be able to create a layer of governance around the use of crypto. So really, our job is to secure the ecosystem. Really believe that any house that's being built needs strong foundations. And as we've seen over the years, security has not always been the best foundation for crypto, and I think it's hurt the ecosystem. And so, but what I can tell you is that out of the 8 million devices that we've sold, none has been ever hacked. So if you use Ledger, you're safe.
Knock on the wood, my friend.
We work very hard. We work very hard. It's definitely no, but you're right. It's hard. It's a daily struggle.
Pritam, can we go with you?
Hey, hi. By the way, fan of Ledger.
Thank you.
Yeah, so I lead Zoth. We are a stablecoin neobank. Primarily, we started our journey by tokenizing real-world assets. Gradually, then build into a ecosystem of yield products and build then payments and cross-border payments, remittance, and card infra on top. We have close to around 2 million users on our B2C platform, and we work with some of the top institutions, as well as we provide our infrastructure as a service to tokenize as well as distribute products on top. Yeah, we have been in this for close to 3 years, and I think when I started, RWA seems to be the most boring area of business, and now obviously stablecoin RWAs are everywhere and kind of gaining popularity. Thank you.
Ekin, can we go with you?
Of course. My name is Ekin Gultepe. I'm the general manager of Mantra. Mantra is a VARA-regulated layer 1 project, purpose-built for RWAs. We are a multi-VM. We started at Cosmos, then we also integrated with Ethereum. We are providing an institutional-grade ecosystem that we are working on, not only on the infrastructure layer, but also the application layer. We are welcoming builders to build their RWA project on Mantra on a permissioned way, but we also support the permissionless ecosystem as well. So Mantra has been around more than 5 years now. It's so many ups and downs in the market. It started as a DeFi DAO protocol and then did its transformation to regulated RWA infrastructure chain. We have quite good backers in the region, GCC, especially in the UAE. Um, Recently, we are also evolving into AI infrastructure support with the recent investment we received by Invenium. They are also based in the US, but also Abu Dhabi. So we are welcoming a lot of promising initiatives, welcoming layer 2 projects and other applications on our chain very soon. And happy to be here and take the
Amazing.
discussions further.
I'll
Thank you.
quickly give an introduction of myself as well. My name is Zishan, and I'm heading business development for Pivot. We are a venture accelerator and venture capital working with early stage startups and helping them, with right from point zero to becoming a successful Web3 company. So today, while we are still awaiting one of the panel, she is already here. I'm receiving messages, but she will be joining us in a couple of minutes. But I'm kicking off this conversation. So what we all are seeing these days that institutions are, not uh, testing RWAs now. They're at the stage where they're integrating real strategies into it. The institutions are now working for it. They're going about it. The transition shift is happening. I have this question and I'm very curious about it. What is the foundational change or shift or requirement you're seeing in terms of demand or bottleneck?
Sorry.
Yeah, we are very elated to have another panelist as well. We just finished off a quick round of introduction. I would request if you can
Sure.
give a quick introduction for yourself as well.
Hello, everyone. Sorry for being late. I'm Clarisse Hagege, founder and co-founder and co-CEO of Dfns. We're a wallet infrastructure provider servicing mostly fintechs, banks. We operate globally. Today, we serve use cases that goes from custody, payments, trading, and tokenization, and we do, on average, we process 5 billion of volume, and I would say today about 60-70% of this volume is stablecoin based.
Amazing. Thank you so much for joining us. And coming back to our question, we were talking about the transitional shift we are seeing from institutions actually adopting to RWAs. My question is, in terms of custody, compliance, issuance, what is the most prominent demand or bottleneck you are seeing when you're talking to these institutions? This question is open for all, and we'll start right from Sebastien.
So it's for all, but I have to answer. Okay. No, so I think what I find interesting is that obviously in the space there's all you were talking about how you've gone through different cycles, etc. And the cycle that we're seeing right now around specifically like stablecoin and RWA is something that's been talked about for like many years. I remember like 20 years ago, because I'm that old, people used to do the same about like mobile technology. People used to say like next year is going to be the year of mobile, and then it never happened. And then the year after is like, oh, it's going to be the year of mobile. And I think that it was the same with RWAs. I think for like many years people have been saying like everything's going to get tokenized, everything's going to get tokenized. But the fact that like stablecoin have now exploded in 2025 creates the layer that's needed to then really have a revolution around the RWAs. And because on top of that, you have a regulatory framework that has changed and shifted and is now like really open, thinking Genius Act and all these different things to make stables and everything around stables, be able to like happen in the US. UAE also has a regulation. Europe has MiCA with its good and bad sides. But you're starting to see a regulatory framework that allows for the development of the technology. So I think that in the discussion that we have today with financial institutions, banks, etc., I don't think there is one that doesn't have some level of tokenization project. And I think in 2026, we're going to see just a flooding of these projects onto the space. And the issue was never the technology. I think the technology was already there. It was really about use cases, and it's about having the regulation in place so that people know that they can actually do these things.
Please, Pritam.
Yeah, so I think we have been building in the RWA space now for almost 3 years, and one of our experiences has been, see, everybody wants to tokenize. There is a fancy thought process that once you tokenize an asset, it will sell more. I get so many requests. Hey, I have this big real estate. Can you make tokens and sell it? The first question I always have is, who will buy it? Why would anybody buy it? So one of the things which most of the RWA issuers struggle is with distribution. And at Zoth, that's what we also faced. And one of the things which, for us, for example, we realized that retail is not interested in illiquid assets. They are interested in trading. They are interested in assets which can be liquid or creating a perp or a liquidity layer on top. And one of the things, for example, we tried to focus more on the infrastructure and owning the user and providing assets that the user wants. And that basically helped. And I think the biggest challenge has been distribution. Everybody is tokenizing asset, but unless you sort distribution and figure out a way where user can buy, sell, trade it, it's never gonna be feasible. And that's, I think, some of the platforms are now starting to do it really well.
You're right. And I would like to add that, when we are talking about tokenizing, everybody has a different understanding of RWAs. If I ask anyone here, somebody would think that, tokenizing the entire building is RWA for them. Somebody thinks that, having tokens in the market, simple tokens is the best form of RWA, like stable coins are proving us. So there is a whole understanding shift also, which is coming, to the users and to institutions as well. Ekin, what do you think?
Well, look, I think you touched the important points, right? How the institution adaptation gonna come in. Obviously, regulation, custody, liquidity, and the data, which is a very important, accurate data, needs to work hand in hand. But I think from POC to production, the market is moving quite fast. But of course, when it comes to institutional adaptation, you need to be cautious. When we look at the market, I think if we exclude the stable coins, right now the RWA is 24 billion. That's a significant amount compared to the growth rate, right? 85% year on year. But the targets that the market wants to see is roughly reaching to tens of trillions by 2030-34. So if you put that vision, we are right now, it's like a tiny sand in the Abu Dhabi desert, right? So there's a plenty of opportunity, but obviously the institutions needs to feel familiar with the products. I want to highlight this. Tokenization is not a new asset class. It's the same capital markets products, but run on a much efficient settlement, much more transparency, and scalable. So we are not really bringing a brand new asset class to the world, but actually having the same assets in a much more efficient approach. But of course, it has lots of barriers at the moment in order to tackle these issues, right? So what I see is, for example, with us, we bet on the future of blockchain in terms of tokenization as a regulation and legal first approach, not tech first. On the POC level, it's tech first. You want to see the technology, you want to see if this really works, can we optimize our operations? But on the next level, on the long run of reaching to $10 trillion market share, it will be regulation first. That's why we took the approach of having the regulatory-friendly, compliant infrastructure layer, and then onboarding important KYB passed infrastructure partners. Custody is very important. So when you think about pension funds or big institutions, obviously the yearly yield rate is important, but the main question they will ask is who holds the keys?
Right.
So that's very critical. And one important thing which is related to the latest investment we received is the data. So one of the bottlenecks I see in tokenization is having accurate data, accurate pricing, especially around the illiquid asset classes, whether you name it real estate or other classes. So how are we going to trust the accurate data? So that's why we did this partnership with Invenium. It's a G42 and Mubadala invested company. What they do is they do a decentralized data infrastructure with agentic AI agents to make the data much more accurate and scalable. So when we look at the future, I think all of these transactions will be handled on blockchain. So I think it's going to come to a point with these adaptations. How many of your transactions are AI agents? How many of them are human-related investments? And it's going to move all hand in hand. So I think putting all these pieces together, we see a bright future, but without building the trust of the data, the custody, and bringing enough liquidity, the adaptation will not come overnight. Well, Rome was not built in a day, so I think
No,
we are at least taking
yes.
the right steps moving forward.
Agree. We'll go with Clarisse now.
Yeah, a lot was said, but I would tend to agree with you. I think there's still a big gap in terms of infrastructure. So yes, the technology is there. I agree as well. It's not that it hasn't been invented. It's not available, but it's not deployed. And I think what we all welcome with the stablecoin surge and the trends that we're seeing on stablecoins is that the reason why it scales so much is that it's the first use case for large institutions that is completely net positive. We're not destroying one side of the existing business we had, for instance, tokenizing a bond. Like, what is the added value for a bank, right? Until you can actually see on-chain settlement, until you can actually see all the operational efficiencies of blockchain, there's actually no net new business for a bank that is asking its existing clients, do you want to tokenize your bonds on-chain, right? So cash is the first net positive use case where actually, if you are a large corporate, if you're a bank operating globally with subsidiaries in hundreds of countries, you can see that repatriating your cash after cut-off hours, 5 p.m. on Friday night for 2 days and being able to invest it at money market rate, well, this is actually net positive business for you, right? And it's amazing because cash is also what will show the efficiency of tokenization at large. If you cannot settle on chain, then why are we even starting, to build any tokenization application, right? So I think what we're seeing here is that first trend, and for many reasons. First of all, because blockchain technology was really discovered, powered by Bitcoin. It's a retail grassroots movement. It's not a B2B, innovation blockchain. Blockchain is a very much retail grassroots movement. So for all these reasons, I think we started kind of on the wrong side of the cycle. And now stable coins, tokenization of cash at large, and wherever we're talking also about collateral being tokenized, all cash tokenization, is actually the first door that is creating, once again, for a lot of institutional investors, a use case to their senior management that, hey, we're going to make money, and we're going to make money with this use case now, because if we're doing cross-border, using stablecoin is going to be efficient, etc. What happens next is that institutions start actually equipping themselves, because how do you show the benefit of distribution if on the other side of the party, the investor doesn't have a wallet? I mean, there's absolutely no benefit to it, right? So the infrastructure has to be deployed massively within a lot of institutions, from banks to exchanges to clearinghouse, in order to be able to kind of build a market at large. So what we're seeing right now, it's actually the early days of this world being equipped. And even though there's no technology blocker, we're still very early in that infrastructure being built, which to me is the basis for any RWA market to start taking off. And I would tend to think that within bank adoption, cash being the first, so seeing global transaction banking, payment side of the banks looking at cash, that capital market, I don't want to say will go last, but will go next for sure. It cannot happen before that side of the banking world is actually equipped. And maybe the last point is that what I also appreciate these days in talking about the challenges on the pure custody side. So first, custody is not infrastructure for wallet. Custody is a very specific financial services, right, that existed in traditional finance, that can exist in digital asset, and I don't believe it will be disrupted, right? I believe the large custodians of yesterday will be the large custodian of tomorrow, because it's a business that requires scale, right? So you'll have sub-custody. So not everyone will deploy their custody setup in order to safekeep their digital assets. But everyone will need an infrastructure to start operating with blockchain, right? To start initiating a trade, to start investing in RWA. So you will need a piece of infrastructure. And the way we see it is that it's a very much an horizontal revolution where for the most forward thinker and decisional forward thinker, how they're thinking about it is that that is now the base layer for the entire financial industry and the financial cycle of the different services to start being built, right? So once again, a lot of challenges still ahead of us, and mostly not challenges, but a lot of work, right, to still convince and deploy a lot of these players. But this is amazing, and that's this. I think it, it will happen next year, sure. But it's the first year where we're actually seeing grounded and production-ready project at scale by the largest institutional investors.
And on building on that, you guys are already are on the forefront of running things and making these go institutionalized. Building on that, the next elephant in the room is credit. So tokenized treasuries and private credit has been exploding now these days. But we see institutions are, they have these requirements of underwriters, auditors, security, identity. All of these challenges still remain. Now, what kind of, this question is open for all. What kind of credit infrastructure are you resonating, with these institutions in play? Do you think it is something, a new shift is coming, or you're just seeing this as a TradeFi thing with new plumbing in place? So what is your take on this? And this question is for everyone, whosoever wants to go first.
So I think credit, I have a certain take on credit and how it is evolving. Means if you look at evolution of on-chain credit and how it started, it primarily started with digital assets based credit, and now there was companies who basically brought private TradFi credit on chain. But I don't think the whole journey scaled that much, especially in the early days. What we are seeing now, obviously tokenized treasuries is credit to governments, but if you look at kind of way beyond that, there is also a significant evolution towards bringing more credit products, especially money market funds, sovereign wealth fund funded products, especially around sovereign debt, etc. on chain. See, one thing which typically what we have seen is that who are the typical buyers of credit in the TradFi world? Typically, these are institutional buyers, LPs. And for them, why would they take an additional risk of a smart contract, for example, when the asset is already available on chain? So what we have seen is there is a certain profile of buyers, especially who are kind of resonating with it, who kind of buy it in a tokenized format primarily due to access to these assets globally without the gatekeeping. I would say access to more stable yield products, which typically credit funds generate. But as of now, kind of asset classes, especially on the credit side, which are doing well, are products like trade finance, bonds, etc., which have very large secondary liquidity. There is a short cycle, there is a strong underwriting. There are a lot of underwriting players, especially on the on-chain credit side, who are building up, like Cicada, who are coming on this space. So that ecosystem is building. So in summary, if you look at the explosion happened with sovereign credit, started with US treasuries, then it's kind of moving to money market funds. We are aware of many more money market funds from top financial institutions, also attracting a sizable AUM or TVL, and now getting into products like trade finance, which have one low liquidity, like low timing, are short receivables, payment finance, etc. Credit in terms of long-term instruments, multi-year instrument that typically happens in TradFi, like long-term lease, long-term, for example, project financing. I think that's still gonna take time because that kind of buyer profile has not built in Web3. But yeah, short-term credit financing, short-term lending is actually picking up. And we are actually seeing a lot of interest from both institutional side as well as some of the DeFi looping products that have been built on top of it.
That's right. Anybody would like to go next? Ekin?
I mean, I can, of course. So private credits, we are also working with a bunch of products around there. So obviously, when we look at how tokenization works, is the most common class is treasury bills and stablecoins, but right after it comes the private credit. private credit could be anything, right? From a small company that is seeking an investment to a large company that hasn't done an IPO yet. So I think, again, I'm going to highlight if you're entering a room that you don't know and you're kind of scared, you want to go safe, and then you know how to get out very fast. So that's why short cycle loans and the strong underwriting is the first thing to go. But that's being said, I want to highlight again the importance of regulations and compliance. So I think having the right wrappers, either it's an SPV model, it's a trust, or whatever the issuing authority is, having that representation strongly legal manner in the TradFi and the representation of it on chain is a way to go in the beginning. So I think it's going to deeper by the cases that default rates are so small, the success and the yield that pays on chain is satisfying people. It's going to create a bigger adaptation day by day. But at the moment, definitely private credit, especially more liquid funds like money market, etc., is the way to go because it's much safer and you can complete it on a shorter term. And of course, what's going to come next is this vaults, right? There will be RWA private credit blended maybe with DeFi stuff, more interesting yields and all that stuff. But again, the market needs to build the trust day by day, and we are, I think, still at a very early stage.
Absolutely.
And I mean, I think when, as Clarisse was saying earlier, talking about stable coins and banks, same thing with credit, right? Like there has to be an upside, right? And I think that what you're seeing right now, for example, like in the US, I can't remember what the exact number is, but there are billions that are being done in like real estate loans for users. And when you think about it, like if you're able to get a real estate loan like on chain in a much faster and efficient way that you would like going to your bank, you're going to do it, right? So that's the upside right there, right? It's like it's to break down like all the kind of like walls that like exist today and that like all the inefficiencies that are like in place and make it like quicker, faster, and cheaper. If you're able to do that, then and then you'll take it to like bigger levels. But I think that right now the first use cases are more like retail use cases than like institutional use cases on lending.
Well, that's right. Clarisse, do you have any?
Yeah, I agree. At the end of the day, I think the reason why private credit is that first real-world assets being tokenized and first also in terms of number is obviously because when you look also historically at the first money market product being tokenized and BlackRock initiative on Beetle, that was a realization of, all right, once again, how do I push this technology to my management? Wait a second, there's all these DeFi traders that are trading and storing the value in stablecoin, and then it does nothing, right? And that was the closest to a risk-free rate or to minimum risk yield that you could add, right? And so once again, that was a pure net positive. We're not removing any business from the existing business we had, but we're actually going and sinking new business outside within the DeFi space. Then there's no stable coins without, U.S. Treasury, right? So if we're all if all fintechs across the world are gonna issue stable coins, well, that needs to keep on going, right? And in terms of, when we look at the use cases that we see growing, for instance, on the payment side, whether it's cross-border, whether it's remittance or global payroll, every time a fintech push a stable coin into someone's wallet, then the next best thing is like, okay, now how do I hold and create retention with these users, with this client? Well, I'm going to offer the yield, and contrary to the bank, I'm going to share the yield, right? I'm not going to give it's not going to be a rent business. It's going to be a business that will benefit the end user. And I think this makes a ton of sense, and we'll see that growing with stablecoin adoptions and with those payment use cases being more and more adopted. And something that we've seen more recently, I would say over the past 6-8 months, is with stable money, you can finally do programmable money, right? And with programmable money, you can finally look at treasury management use case. And there again, it's now that I have my money tokenized, everything pulled into one omnibus wallet, then what are the yield options? And how do I swap these stable coins with tokenized money market funds with slightly risky yields, so maybe some corporate bonds, and I like what was said about the securitization, because this is also something that is super early. Now, asset managers are thinking also, what other type of papers can I give to those holders of stablecoins in order to swap and get more yield with limited risk? And I think that's kind of that pure value of that private credit and mostly on the limited or controlled risk approach, which is making this asset class so performing these days.
So that's right. And when talking about adoption, as you're mentioning, when we're talking about onboarding large institutions in play, it involves large amount of capital. It involves auditors, the whole 9 yards around that. So my next question is, for Dfns and Ledger, for Sebastien and Clarisse. What do you think? How our technologies or your technologies at your specific companies are evolving to onboard these large scale RWA utilizing institutions? So do you think that there is a major shift happening in terms of the evolvement of technology, or how do you see this onboarding this large scale institutions with you?
Yeah, I mean, I think that what's interesting is that when we built out our technology, we built it in 2018, thinking that banks and financial institutions would get into crypto in 2019. So we're a little bit ahead of the wave. But the good thing is that we're able to build something which is very linked to the way that they are doing things today. And Clarisse was saying something that I totally agree with on the fact that when you look at the custody business, I mean, even though and no shade on all the great custodians and who a lot of them are our customers, et cetera, that are working in the space, but at the end of the day, big banks are going to go with the guys that they know and the BNYs, et cetera, of the world. Now, what's interesting is that they are going to need, as more and more people use, or their users or customers are using digital assets, they're going to need a new layer of security that they need to build, but they're going to build it based on what they know. And I think that what we need to be able to do is to bridge the gap. And I'll go back also to what we were talking about earlier about how back in the day crypto was really its own space, and kind of, I think in some ways there was this idea it was crypto against TradFi, and now it's kind of this merging of the two. And so the idea is to say how do you make it so that we know who owns the keys, that you have the right, and for us philosophically what we strongly believe in is this idea that it has to be hardware based. It has to be with the customer holding the keys, and it has to have clear signing, because that's super important to be able to have this vision as to what you see is what you sign. But there are other ways to do it as well. And at the end of the day, it'll be decisions made. I think the risk profile of the different financial institutions is different, and they'll use different technologies based on their needs.
You're right. Yeah.
Yeah, I think it's very much use case based, right? And we've always had this approach, which is there's not one technology fits all. If you're building a retail application for payment, you need scalability, you need fast latency, you don't need too much chain coverage because probably you're going to build on one or two chain. If you actually building or tokenizing bonds for large investors, or you need to support a blockchain that is going to be privacy preserving because turns out that your investors will want their trades to be out of the open. You're going to be regulated maybe in Hong Kong, where you need 95% cold storage, 5% hot. So all that has to be use case based. It's what are we building, for who we're building, in what type of constraints. So first big major constraint is regulation. If you're a global player today, you cannot just have one device, right? Once again, in Turkey's regulator will tell you put everything on-prem. In Singapore, it's written in the regulation that you need an air-gapped solution, which is something very specific. In Japan, forget about all that. It has to be an HSM with you, right? In UAE, all the data needs to be on, could be UAE cloud, right? Could be AWS, but has to be hosted in UAE. So first, regulation is a major technological constraint, right, actually, and will kind of dictate how to build this. And then after, it's what we're building, for who. Is it distribution at scale to retail investors? Is it B2B with actually assets that are not going to be moving a lot? And depending on all those answers, well, you'll adopt a technology that is going to be fit for your technology, and I think for your use case. And I think this is very much how we've built Dfns since day one, which is we knew from the get-go that if we wanted institutions to get into the room, there was no pushing them through their throat an ideology, which is that's how it should be done, right? These guys, they've been operating in the space for 50 years. They know how to use HSM. They barely know MPC technology. Blah, blah, blah. You know, there's so much legacy. They have authentication system in place. They will never accept that any trader has a key share on their phone because it just operationally, it makes no sense, right? If you have attrition, you're not going to do a new key signing ceremony every time you have a new trader coming in and out of your trading floor. So all these constraints are super important if we want to make sure that we can actually enable from an infrastructure standpoint more institutions to come in this space peacefully, but also at minimal cost. How do we integrate blockchain technology without revolutionizing everything? And by making sure that we understand the constraint in which this player operated before.
Now, when we have discussed about infrastructure and custody, now platforms like Mantra and Zoth come in where where actually institutions are interacting with RWA. So my question is for Pritam and Ekin right now. What do you think, from your perspective, is an institutional ready RWA platform should look like? And on top of it, if you have to bet on one existing asset class which would be moving on chain first, which that asset class would be? Ekin, we can go with you.
Sure. So basically, I believe the future of finance is tokenization, like many other people. And that means, I think, you will have your digital wallet that carries all the assets you have. This is including your real estate, your car, your valuable items, as much as what you're making, but also your debts, your mortgage, your loans, your credit card statement. Everything will be very liquid, very available. You can able to trade these depending on the regulatory allowance, of course. And everything that you have in the finance, whether it's illiquid or liquid, will be available under your wallet. This is gonna help to get rid of all these intermediaries, all this lack of process. There's not gonna be T+2 to settle things. So a great future of finance coming ahead. I think it's a revolution and we are in the first stages of it. But again, it creates, well, unknown things create this fear, what are the risks? So with Mantra, for example, I see a feature of the whole life cycle of from a term sheet of a deal into a issuance, from issuance to distribution, from distribution to a liquid secondary market, and all the audits and the data around it happening together same time at Mantra Chain. That's why we put compliance as first to build a regulated infrastructure, and then we are offering a permissioned layer of applications, and then building our own RWA DAX as we speak in order to create that secondary market and everything around it, and then using AI agents and again our partners to bring the right data, reliable and scalable on chain. So how I see the future of a full compliant institutional ecosystem is the core compliant infrastructure partners, compliant KYC users, even the validator level of things should be also compliant, and then having a trustful, scalable, liquid ecosystem day by day building the bricks. And that's what we are here for, and that's our vision. And your second question was what?
What will be that asset class you see, fully going on chain, existing asset class?
Yeah, I think the market's already defined in a small scale. The first asset class, let's think about a triangle and let's put it upside down. The biggest layer is definitely US Treasuries, the safest stuff, and then stable coins that pays yield. But after that, private equity, private credit. And then I think what's going to take over right now, it's more commodities. But I think with the Stable Act and how we see US is moving ahead to define the securities versus tokenization is, I think, the equities and then the public bonds are going to take a huge percentage, followed by, of course, commodities, whether precious metals and agricultural commodities. And then it goes to real estate. Obviously, real estate has lots of moving parts, and it's a very political thing that government involves, even though there's a huge appetite. Like with Mantra, I'm receiving daily inquiries for real estate tokenization. Of course, there's the SPV model that works. However, the real thing is really tokenizing the title deeds, which there's a lot of initiative taking place. Pilot projects are taking place in Dubai. So I see that's coming in, but not as of tomorrow, due to, again, so many moving parts. And then obviously fine arts, precious diamonds and all that stuff are really at the bottom. But again, this is a process that with the
course.
bill and regulation gonna take place. So it doesn't matter what I think. The market already defined what's
Right.
being adopted. Yeah.
What is your take, Pritam?
So I think two questions that you asked: what are more institutional LPs looking for? I think there is lot of capital moving on chain. The most important what we are seeing is the appetite is right now into assets which are transparent. Ekin kind of added to the point of real estate. Yes, there is demand, but the problem with real estate as nature is the illiquid asset as well as the lack of transparency. So assets which have strong oracles in real world, which have strong secondary market, have right kind of I would say standards, are getting more traction from institutional LPs. We have been even like in ADFW conversation with some of the largest asset manager. They are looking at a lot of pay-5 vaults out of LATAM, trade finance products, bond, etc. Primarily because on-chain brings that transparency, and these financial products which were not really easily accessible earlier are becoming accessible now due to transparency. So that will be the first wave, and that's where most of the institutional interest is. And maybe as things kind of get better, it will get into more illiquid kind of assets like real estate. Now, what I'm most excited about kind of getting big in this space, I believe debt products, bonds, pay-5, trade finance kind of products will grow heavily in size over the next 12 to 18 months, primarily because if you look at the typical crypto buyer, retail and institutional, I believe they either operate in the highly risk zone, which is delta neutral, hedge or altcoin trading, or in the highly safe zone, which is treasury bonds and T-bills. So pay-5 vaults, bonds, etc. are fixed income products which are finding traction now, and I believe they are going to be a multi-billion or large TVL products in this space.
Right. So I think we are running short of time, but my last question, and I would request only a 1 or 2 line answer from you. If we think of next 5 years, from 2026 to 30, what will be the signs for you that RW has become truly an institutional asset class, and not just a narrative, not just a pilot, not just a PR announcement? What will be that one sign you will see that that is happening and we are there? So, Sebastien, we'll go with you.
I mean, it'll be the easiest way is to see the percentage, the assets that'll be tokenized and they'll be like traded, etc. All liquidity. I'll think, let's say like 10%, 5 to 10% gets to the market. That'll be like their stay. Yes.
Pritam.
See, today RWA is an asset class of crypto. I believe in 5 years from now, crypto will be a subset of RWA because there will be too many tokenized assets and it will be overall bigger than the wider digital asset ecosystem.
Very interesting take.
I mean, what I think is the expansion of digital wallets that everybody carries in their phones with all their assets listed there. And then for the institutions that doing what they're doing, but you're not even aware that the transactions are settled on blockchain, will be the proof in the pudding that the adaptation is reached to the targets that we currently put.
Right.
I exactly agree. I think we're all building eventually for retail, right? There's no asset manager that doesn't have an end consumer that is a retail customer. So in 2030, we all have, Apple Wallet, an actual wallet, you don't even know it. It's stablecoin, you don't even know it. And your bank also has behind a wallet infrastructure and everything is tokenized from cash. Then from there, yes, RWA can just flow.
Interesting. So we are out of time, but RWA as a space is moving very fast, And today we were very lucky to be speaking to people who are actually bringing the theory to reality by making the rails of RWA real. I would request a huge round of applause for the panel. Thank you so much.